Hello and welcome class 11 commerce students. Today I will discuss about equity shares from the chapter business finance. In my last class I have explained about owner's fund and borrowed fund. Now equity share is one of the shares of the owner's fund. One of the important source of capital from the owner's shares. I have told you while teaching that uh, owners fund, I have told you that equity share is the major part of this owners fund. It consists of the major part of the owners fund. Issue of the shares is most important source of raising long-term finance. The amount of capital that can be raised from the members of the public is divided into units of equal value. These units are known as shares, and the aggregate value of these shares is called share capital. Company can raise two types of capital. One is equity share capital, another is preference share capital. Today in this class I will primarily focus on equity shares. Now equity shares are those shares which do not carry any special or preferential rights in the payment of the annual dividend or repayment of capital. The rate of dividend on such shares is not fixed. I have told you earlier also, dividend on equity share is paid out of the residual profits left after paying interest on debentures and dividend on preference shares. So after the payment of dividend, after the payment of interest to the debenture holders, and after the payment of dividend to the preference shareholders, whatever profit will be left over, from that profit dividend to the equity shareholders are paid. That means it is the least priority since it is from the owner's capital. That's why in the last class I have told you it is a very risky capital. Now equity shareholders are paid at the time of winding up of the company after clearing of all the debts, and preference shareholders have been fully paid off. They are entitled to receive what is left after all prior claims have been satisfied. Therefore, equity shareholders are the real risk bearers. I have told you earlier also. So, they are called the real risk bearers. Now, they are entitled to receive what is left over after all the prior claims have been satisfied. They enjoy the voting rights in the management and control over the company. The amount raised by the issue of equity share is called equity share capital. What are the features? These are primary risk bearers, the equity shareholders. If the company suffers losses, the equity shareholder have to bear the loss, and even they can lose their entire investment. So they are primary risk bearers, that I have told, primary risk bearers. Secondly, claim over the residual income. They can only claim over residual income. Equity shareholders have control over the activities of the company. The equity shareholders have voting rights. They are the basis for loans. Equity share capital improves the credit worthiness of the company. I told you earlier also. Higher rate of return. The rate of return for debenture holders, rate of return for dividend payment to the preference shareholders are fixed. But at the time of profit, the debenture holders get or enjoy a higher rate of return, higher return on their income. On their fixed income, they get the higher return. Preemptive right. The equity shareholders are given preemptive right by the provisions of Companies Act. According to this right, whatever company is planning to issue new equity shares, it must offer the shares to the existing shareholders first. This right protects the controlling right of the equity shareholders. So, they are given the preemptive right. Irredeemable. The equity share capital is not redeemable during the lifetime of the company. It is not refundable. It is refundable only at the winding up of the company. So it is a permanent capital, no obligation as to dividend, no such. This is the main advantage, that no obligation of the dividend. There is no burden in respect of dividend that the equity shareholders, because the company is, it is not compulsory to pay dividend always. Dividends are payable only if the company has adequate profit left over after paying off all the claims, after clearing of all the debts. Only then the dividend is payable. It is not a compulsory payment. It is not compulsion. High credit standing it has got, I have told you earlier, and no charge on asset. For issuing equity shares, the company has not required to mortgage or any kind of pledge its assets. So no charge on assets. Suitable for adventurous investors. Equity shares are the ideal investment for bold and enterprising investors. They get handsome dividends and the value of their holdings appreciates during boom periods. In addition, they enjoy the full voting power of the company. They also have the preemptive right, I told you, to buy new shares also. So bold investors, adventurous investors can always take it at their own risk and invest in the equity share capital. Only high risk is involved because it is, I have told you, it is a permanent risk capital, because always you have to take a chance and sink. The equity shareholders always sink and swim with the company's position. During depression, they get no dividend and the market value of their holdings falls drastically. The collateral and resale value also declines. Equity shareholders lose heavily if the company fails and goes into liquidation. Therefore, equity shareholders do not appeal to the investors who want safety to their investment and a regular fixed return. Also, this is time consuming. This is also called time consuming. Why time consuming? Several procedural formalities are involved in making the public issue of shares. Moreover, the issue cannot be made at the time of company's wants. It depends on market condition. Then unsound dividend policy is also there. During boom period, profit tend to increase. The directors may decide to distribute higher dividend to win the cooperation of the equity shareholders. They may overlook the reserves for contingencies and replacement of assets, etc. So dividends are controlled by the directors. The rate of dividend is decided by the board of directors. Shareholders cannot demand higher dividends than those recommended by the board. Therefore, investors may consider the equity shares unsafe and non-remunerative. There is a speculation tendency also. That also you have to include. Speculation tendency. What does that mean? During boom periods, profit of the company and dividends on equity shares tend to increase. This leads to excessive speculation in the prices of equity shares. Concentration of control. Any new issue of equity shares must be offered first to the existing shareholder. As a result, there is no concentration of control in the hands of few. So there is dangers of overcapitalization. I have told you, equity shareholders is not refundable during the lifetime of the company. A mistake of estimating financial requirements may therefore result in overcapitalization, particularly when the company's earning capacity declines. Equity share capital may remain idle and underutilized. I have told you earlier also. These are all the facts and these are all the pros and cons. Takeover bids are also there. Loss of opportunity of trading on equity are also there. So having many advantage and disadvantage, these are the features. These are the features of the primarily main owners fund, that is equity share. In my next class, I will discuss about preference share. Till then, goodbye.